Hello everyone, my name is Michael Piccola. If you don't know who I am a mortgage lender out of Cincinnati, Ohio. I specialize in helping people buy homes and invest in real estate. If you have not yet, go ahead and subscribe to my channel. Would love to see you come back, but today we are going to be discussing conventional mortgages. While we're discussing conventional mortgages, we are going to discuss the background of conventional mortgages, the credit limits, the loan limits, the down payments, the debt to income ratios, seller concessions, and then how can you decide if it's the right mortgage for you. Let's jump right in with the background of it. Now, conventional mortgages, believe it or not, make up around 80% of all the mortgages out there. So they're a very large part of the real estate industry. They are backed by a government entity by the name of Freddie Mac or Fannie Mae. Both of them are separate entities with different guidelines. However, they together make up about 80% of the market out there. You do not directly go to Freddie Mac or Fannie Mae, but go through companies like myself to get those types of loans. So normally, when it comes to your credit, they're set aside for anybody over 680 and above. However, guidelines do state that you can go as low as 620, but the situation has to be right. Like you have to have a good debt to income ratio, maybe a larger down payment, or multiple people on the loan to lower that risk. Loan limits are ever changing. As of 2025, the loan limit on conventional mortgages is $806,500 unless you're in a high cost area such as California, Nevada, Hawaii, Alaska, and some parts of New York. Now, this is the biggest portion of it, and going into the down payments. Now, everybody always thinks with conventional mortgages, you need to put 20% down. That is actually a myth. You can put as little as 3% down if you are a part of a first-time homebuyer program or if you are part of a medium census tract when it comes to your income. You can put as little as 3% down with some of the programs. But I would say on average, 5 to 10% is your average down payment that you're going to be putting down. So simply, all you got to do is decide the loan amount that you want or the purchase price that you're going after, and then do the math from there with the 3%, 5%, or whatever you think may work the best. Let's move on to debt to income ratio. Now, obviously, debt to income ratio is going to be based off of you and your profile. They do allow up to 50% of your gross monthly income to be covered with the mortgage and the debt. However, if you're looking at buying a house and you're going to be hitting that 50%, you may want to question a few other things, or maybe you have some outliers out there, like maybe somebody else on the loan doesn't qualify. And it makes sense to just go up to 50%. But you don't want to use 50% of your gross monthly income. If you're going to want to stick to just basic guidelines and make sure it's going to be perfect, you want to probably stick to closer to 30% or 30 to 36% of your gross monthly income going towards your mortgage, and then keeping that back end ratio of 45% or lower, and you will not have a bad time. Now, obviously, credit and everything else plays into that, as mentioned before. However, you just want to make sure that it's going to work for you and your family. So if going up to 50% makes it work and you do get qualified, obviously, ease with caution. I'm not going to tell you to do otherwise. So moving on to getting the seller to actually cover your closing costs, or what we call seller concessions. There are rules. So on average, you're going to be able to get 3% of the loan amount for your seller paid closing costs. Simple math, $100,000 loan amount, you're allowed to get up to $3,000. That is if you put under 10% down. You are allowed to have the seller cover 3%. If you go anywhere between 90 and 75%, you can get all the way up to 6%. And if you're going to put over 75%, then you can actually get the seller to cover 9% of your loan amount. Now, I have had some situations where we've had some high seller concessions, but that's not a norm, so I would not look into that too much. It's obviously a conversation between your lender and your real estate agent when you're looking at the property. Sometimes if a property's been sitting a long time, the seller is willing to make some negotiations. So this all put together, how do you decide if it's right for you? that is going to be a personal decision based off your credit scores and the payment that you are going to be getting, and if it does make the most sense. I always say keep it to a 5-year plan, right? What is going to happen in the next 5 years? Now, I know that is hard to predict most of the time, but if the payment makes sense and the fixed debt option is there, you should be okay. Now, let's go into some other caveats about conventional mortgages. And I'm going to be talking about the type of locked loans you can get. There are 2 types of loans that you can get. There are fixed rates, and then there are ARMs. So we're going to go with the fixed rate because that is the most popular. A fixed rate means the mortgage payment, and when I say the mortgage payment, I'm not talking about the entire principal, interest, taxes, and insurance payment. I am talking about just the mortgage. That will never change if it is fixed rate. You have different years or different terms that you can do. Lowest being 10 years to 15 years, and then you have 20 years, and then 30 years. And you can pick anywhere in between or lower to go with that, but sometimes the rate will not adjust for that. So right now, the best one out there, however, it is the highest and the longest, and you're going to pay the most interest, that is going to be the 30-year mortgage. The other caveats that you kind of want to look at and kind of pay attention to are, are you going to be able to go into that property and make it better and get more equity in your property to get rid of your PMI? Now, that is the cool thing about conventional mortgages is with that PMI, it does fall off when you hit 20% of your value. So you have to pay your mortgage down by 20% and hit a 80% loan to value. Now, when you hit that 80%, you can reach out to your servicer who pays Freddie and Fannie directly for that mortgage to make sure that they're servicing it and getting the interest payments. That is what they're looking for. They can go ahead and get that removed. If not, they will actually fall off at 78.8% loan to value. So as long as the loan to the value of your property has gone up, you will be able to get rid of that PMI. So it is a short-term thing when it comes to the PMI, unlike other mortgages out there. So if you have any other questions or concerns, just let us know. But let's go over our recap real quick and make sure that you have an understanding of what we talked about. In the very beginning of the video, we talked about the background of conventional mortgages, who backs them, the credit that you're looking for to have there, your loan limits, your down payment options, your debt to income ratio, your seller concessions, and then of course the different types of locks and your different types of terms. So if you have any other questions or concerns and want to reach out to us directly, all of our information is down below. Our website is teampiccolaLoans.com. Again, my name is Michael Piccola. I am a lender out of Cincinnati, Ohio, and we do represent roughly 25 other states in our beautiful nation. So if you have any questions or concerns, let us know. Look forward to working with you. Talk soon.